What is up, guys? So today we're going to be talking about some retail trading patterns, and this is going to be mainly aimed at beginner traders, but stick around to the end of the video because any trader of any degree of experience is going to be able to appreciate a lot of the concepts, mostly psychological, that we're going to discuss throughout the video. And these concepts can be applied to not just trading patterns, but pretty much any style or form of trading. So I really do think that you're going to be able to get value from the concept overall. Really quick, I just want to give a shout out to the sponsor of this video, Coin Market Manager, the lead journaling and analytics tool for crypto traders. Connect an exchange account via read-only API for fully automated imports, saving you hundreds of hours of manual data entry. Analyze your trading habits in just a few clicks and improve strategies with data-driven insights. Link in the description below. Alright, so all my beginner traders out there, I'm sure that you guys have been drawn towards trading patterns. Patterns are kind of the most simple and retail-friendly way to trade markets, and that doesn't necessarily put them down. It doesn't necessarily mean that, they're not going to work because everyone is doing the exact same thing and, there's not any value there. That's not necessarily what that means. There is a lot of value in pattern trading, and even though it's simple, it still can be pretty daunting. There is a lot of patterns. There's head and shoulders, bull flags, rising wedges, descending wedges, ascending triangles, orangutan patterns, dinosaur patterns, Bart patterns. There's a lot of fucking patterns, okay? But really, we only need about two. So we're going to simplify everything. We're going to run through the entire concept and way to think about pattern trading. And you're going to see how just with two patterns, you can pretty much navigate the market at all times. So let's go ahead and let's dive right into it. So the pattern to the left here is called an ascending triangle. And all this really implies is that we're forming higher lows, but we're finding equal highs. These higher lows implying that support is stepping in. So buyers are stepping in to support price action sooner each time, but sellers are still only able to step in at the exact same price point each time. So eventually what this is implying is that we will break and exhaust those sellers because they continuously are getting tested at the exact same region, whereas our buyers are more and more eager over time to step in sooner and buy higher prices. So the idea is this climax point is eventually going to resolve to the upside, and we're allowed to resume the uptrend thereafter. So before we go into any more detail, let's talk about this pattern. This is called a descending wedge. Now this is a bit different because even though this is technically a bullish pattern, you can see that we're finding lower highs and lower lows along this pattern. So this would be a bullish pattern, but in a downtrending market. However, it still implies upwards. So the idea here is that price is falling, but eventually we're going to have this kind of like supply crunch. Once price reaches a significant level or a specific price point, then demand is going to all of a sudden shock the sellers and price can move significantly higher thereafter. So they're drastically different gists, right? This would be an uptrending market and this would be a downtrending market, and yet they both imply upwards. So they're both technically bullish patterns. Now, that's all fine and dandy and very simple, but this is not Investopedia. I'm not advocating for you to go start finding these two patterns and start trading them all willy-nilly. Because the honest truth is, it's probably not going to work. You see, trading patterns are incredibly simple on the forefront, and that tends to be, at least in my opinion, why beginners are more drawn to them. But there is a lot of thinking that needs to go into it in order to use them effectively. So the idea that I'm going to introduce is something you may have heard me discuss before, but it's the idea of the three principles of what create a trader. And these three principles are perceived probabilities, risk reward, and personal situation. So very quickly, I'm going to give a summary of each one, and then we're going to tie it in along with these two patterns. So number one is what I'm calling probabilities, but I actually like to put perceived in front of it because the honest truth is in markets, we don't actually know what the probability of something really is. This is not blackjack or 21, whatever you call it. We don't have the ability to start creating standard deviations of what the probabilities are for a specific outcome based on how many tens are currently on the table. So the way that I perceive probabilities is that if we have something swaying towards the upside direction, the probability of continuing upwards is probably better than if we were not already heading in the upwards direction. And the way that I think about that is a snowball to snowman kind of way of thinking. So that is to say, if you ever wanted to get to here, well, you would have to start breaking out of lower time frame trends first and then reverse the trend overall. So you would have to start finding snowballs of weakness, and then you'd have to compound onto those arguments over time. So as time goes on, higher time frame arguments are also flipped bullishly, and then you can apply some kind of context and say, hey, we're uptrending on every single time frame, and this pattern that I'm visualizing is an uptrending portrayal, and it's a bullish pattern. So the probability of this pattern actually resulting in further upside, I would have to perceive as greater than this one. And the simple reasoning is, in this pattern, we're already heading to the bottom right corner. So in order to start heading to the top right corner and fulfill what this pattern is implying, we would need to start breaking structures and show strength on lower time frames first. So right off the bat, we have a way of perceiving the probabilities for both of these patterns. This is higher probability, and this is lower probability. So when I say that to you, immediately your brain starts to think, okay, so delete this pattern, don't trade it, and only trade this one. But in markets, and also probably in life, there's a balance to most things. And that brings us to number 2, which is risk-reward. So when we're talking about something like risk-reward and we're applying it to this ascending triangle, the thesis is we can buy any one of these lows, hide a stop loss below the previous market structure low, and target a breakout of the pattern overall. Now notice that this gives us a 4R trade, more or less. The risk-reward for things is a lot more tangible than the perceived probabilities because it's really just this number. So we have a pretty definitive way of being able to determine what the risk-reward for each of our trades is. At least when you're talking about a trade-to-trade kind of basis and not positioning a portfolio and managing a portfolio overall. But in this specific example, when we go and look for the risk-reward on the descending wedge, we might have a setup that looks something along these lines. Notice how the risk-reward is significantly higher in order to balance out the fact that the probabilities of the trade actually playing out are much lesser. So who's to say that one setup is better than the other? This one has higher probabilities to achieve 4R, but in the event that this one works, we reap 13R. R just meaning one risk, whatever you are risking in the event that this trade is stopped out. So if this one wins, we make 4 whatever we were risking. If this one wins, we make 13 whatever we were risking. Here's the most important concept out of these 3. It's the personal situation. When we're discussing these 2, this creates a setup. So these that we can visibly see on the chart. However, something that tends to go unaccounted for or maybe underappreciated is the personal situation of the actual individual trader. So let me just give you a quick example. This does go deep, but let's not dive too deep down that rabbit hole or else we might be digging forever. Let's say that you're positioned in 3 trades of which you are already betting on continuation. Especially for crypto traders, this is a pretty important concept and something that you're going to find yourself in pretty frequently, where essentially if you're in 3 different altcoins, you're really not taking 3 different trades. A lot of the times you're going to find that you're essentially in the same trade 3 times over. More or less, and yes, this is very general, and if you know how to spot outperformers and strong outliers to the greater market, this doesn't really apply as much, but generally speaking, you are going to be taking very similar trades, and what you'll come to realize is that if you're in one trade and it gets stopped out, you're probably getting stopped out of all 3 of those trades. Even though they're 3 entirely different assets, they tend to have the same basket, so in crypto, in altcoin, and it tends to be that whatever one altcoin is doing, it's a lot more likely that another altcoin is probably doing the exact same thing in a very similar fashion. So maybe your personal situation is that you're already in 3 continuation setups. So essentially you have the same basket of risk. 3 times over, you're in the exact same trade. If one of those trades plays out, then all 3 of those will likely play out. If one of those trades gets stopped out, all 3 of those trades might get stopped out. So maybe you're looking for a different form of exposure, in which case it might be in your best interest to bet on a reversal setup. Or let's flip it. Let's say that you're in 3 different reversal setups. You would have to acknowledge that the probability of those trades playing out is pretty weak. It's just that if all 3 play out, suddenly you're a genius because the lower probability bet has now paid off for you. And the risk reward that comes along with having taken that low probability bet is significantly more rewarding. Consider it like betting on the underdog in a UFC fight. You're going to get paid out more for betting on the person who's less likely to actually win the match. That's how we want to perceive the exact same thing. So in this case, if you're in 3 reversal setups or descending wedges, maybe you're looking for a different form of exposure so that you can bet on continuation just in case the market does decide to rally, but your coins that have been downtrending decide to continue downtrending as the trend implies. At least that way you can be betting on a stronger performing coin that is a lot more likely to actually break out. And that way you're kind of finding different baskets of exposure to maybe hedge your own longs with other longs. To kind of say that, hey, maybe if I get stopped out on all 3 of my reversal trades, at least the higher probability bet, the outperformer, the uptrender, if that trend does continue uptrending, which I would think it's likely to, that would at least counteract the 3 losses that I've just taken on the other reversal trades. That is just one application of considering your own personal situation. It's probably something that you're going to find yourself in very frequently because the honest truth is, as a trader, it's less about the patterns, it's less about what kind of system you're using or how you're making your technical analysis, and it's a lot more thinking than anything. A lot of it is just pros and cons and considering your own personal situation and how that pertains to the pros and cons of whatever decision that you're about to make. At least from what I've witnessed from over 7 years of trading, we tend to not really put too much merit on our own personal situation. And again, this goes very deep. That is to say that nobody can really tell you how to trade. Nobody can tell you if this is a good setup or if this is a better setup. Nobody can tell you how much exposure you need to have to the market. Do not try and convince me for 1 second that someone who's 18 years old and still lives in their parents' basement has the same risk appetite and therefore personal situation as someone who's 40 years old and is the head of a family. Those 2 people would have drastically different personal situations. So you have to consider things like how much money you're bringing in, how much money you already have in a savings account, let's say, how much money you're willing to invest, how much money of that investment you're willing to dedicate to trading, how much of that trading allocation are you then going to break down between spot trading, higher timeframes, and scalp trading, very low timeframes. These are all just very basic examples. The personal situation idea is very expansive, and what you're going to find is that through your trading journey, that is going to be the thing that you come back to time and time again. Reconsidering your personal situation, reassessing things. Every time that you get a promotion, every time that your portfolio increases just a little bit, every time that you have unexpected bill that impacts your net worth, that personal situation idea is going to be what you come back to over and over again. And what you're going to find is that a lot about markets is less about trying to figure out what patterns you need to be trading or what system you should be using. And it's a lot more about mastering yourself. Now, the reason that I spent so much time on these concepts is because they are incredibly important, and again, that is going to be the thing that dictates your success or your failure in markets, and not whether the ascending triangle actually does what it's supposed to, or whether this time around the descending wedge actually reverses. And another concept to keep in mind, because even though both of these imply the exact same outcome, the context of them is drastically different. So a lot of the times people will look down upon reversal trades because they're such low probability, and they'll say that they're bad setups. But what I'm here to tell you is that it's not necessarily a bad setup, but what tends to happen is that people are sizing into this reversal trade that has a low probability of actually playing out as if it had a high probability to do so. They see the risk reward that's on the table, they think, oh my gosh, 13R? That means that I'd be up this much. And they kind of tunnel vision on that idea, and they neglect the fact that a lot needs to happen in order for that trade to actually play out. And then inversely, people will look at this continuation pattern, which is high probability, even though it comes with a pretty low reward relative to the reversal trade, and they'll kind of scare themselves out of the trade for whatever reason, even as it's starting to play out. As we break out of that ascending triangle, people will start to think to themselves, oh man, I better get out. This is looking pretty toppy. Maybe I should just take my profit and run while I can. But they fail to recognize that in order for these trades to pay off over time, you have to kind of let them run and play into the fact that it's likely to continue paying off until eventually it doesn't. So that is to say that you're playing into the probabilities whether you know it or not, but the reward that you're getting is not enough to overcompensate for the times where the ascending triangle actually doesn't do what it implied it would do. So to sum it up, the issue is not whether you're trading ascending triangles or you're trading descending wedges. The issue is that you're trading ascending triangles as if they have a low probability to actually play out, and you're not reaping enough reward as a result of doing so. Or that you're sizing in too aggressively into reversal trades when it's pretty logical to think about, hey, this doesn't really have a high chance of actually working. And again, everything that I just said just discusses these two things. And these two things are the easy part in markets. This is the vanity. This is the green and red pretty little, hey, let me put on a setup and show it to my Twitter following and pretend like I'm up a gazillion bucks. Anybody can do that. That's without even discussing the personal situation. So if you're still struggling with this, don't freak out. Every person struggles with it, especially if you're a beginner. I would hope that this video puts you on the right path, help you navigate the way to think about these setups. But really, what's coming is that massive roadblock of trying to master yourself and consider your personal situation at all times. And that's going to lead you into the more advanced trading concepts of which most of my YouTube content revolves around. So before we wrap up the video, I just have a quick announcement. I do have a private Discord if you do like my educational content. Anybody is eligible to sign up to that private Discord. All you have to do is use either my Bybit or my Femex referral link, register an account there, and trade there moving forward, and that'll grant you access to my private Discord, of which we host 3 live streams a week. There's daily and frequent live market updates, as well as my personal trade ideas and my top altcoin picks on the crypto market every single week. So if you're interested in signing up, the links will be in the description below. And really quick before you go, for anyone who is trading on Bybit, Bybit is sponsoring an iPhone 15 giveaway on my behalf to anyone who fills out the Google form, of which you can find the link in the description below. It's really easy. All you have to do is submit your Bybit user ID and your email associated with your account, and you can be eligible to win an iPhone 15. So with that said, I hope that you guys enjoyed the video. Much love, and take it easy.